Hello guys, the semester has started, the students are back in class. Actually, not all students are back in class, some of them are taking the classes online because traveling is still a little bit difficult. So in this video, I'll have to look at calculating net income in an income statement. And I'm going to use an example of McDonald's Corporation to make this a little bit more interesting, not as dry as you have it in the textbook. So here's the income statement for McDonald's. At the top, you would have revenue. In this case, we have different kinds of revenues. Revenues from the restaurants operated by McDonald's Corporation and revenues from franchised restaurants, some other kinds of revenue. I simplified over here in our Excel sheet with just, say, sales revenue for some generic company. After that, you'd have some kind of expenses, different types of expenses, starting with operating expenses, expenses that are directly related to running the business. In case of McDonald's, that would include all the costs of buying, say, potatoes and meat for those hamburgers and chips that you might buy in the restaurant. For our generic example, I'm going to call it cost of goods sold. And for this cost of goods sold, I'm going to combine these three numbers. So if you add up these three numbers, you'd have 2036.2. That's probably in millions. And by the way, this income statement is for the second quarter of this year. Then you have other operating expenses that are kind of layered on a sub-level here, including depreciation and other expenses, admin expenses. I'm going to keep it simple here, keep one layer of expenses. I'm going to have depreciation at 71 and admin and, say, marketing expenses. I'm going to allocate these two numbers, $693.2 million, into admin expenses and marketing expenses. Say 300 for admin and the rest for marketing. That would allow me to calculate earnings before interest and tax. I would do that by taking the sales revenue and subtracting all the operating costs. You'd see that called earnings before interest and tax in the textbook, and we see that as operating income in our McDonald's example. There are, of course, some other expenses not directly related to running the business or to operating the business. Let's simplify this a little bit into just simply interest expense. As the corporation actually seems to have some income as well, maybe from selling some securities or maybe from interest on some cash deposits in the bank. Whatever, I'm going to take a net of this and just call it interest expense, 312.4. That would allow me to calculate earnings before tax. That's how you'd often see it called in the textbook. In our example, we have it as income before provision for income taxes. That's simply EBIT minus interest expense, 648.7 and 648.7. Let's have tax payment at 164.9. And finally, net income equal to earnings before tax minus tax payments. 483.8, same as in the income statement for McDonald's. I hope it's helpful. Read through the lecture notes online and have a nice day.